So you may have heard on CNBC or some investment publication, or maybe even your coworkers talking about how the markets are at all-time highs, suggesting that maybe now is not the best time to be investing. Well, today I'm going to build some context around the subject and use some examples to give you the confidence you need to continue to build wealth. Starting off, I think it's important to understand that when the markets hit all-time highs, this is really not that rare of a phenomenon. I mean, last year in 2018, there were 18 new all-time highs. And the year before that, in 2017, there were 62 all-time highs. And since 1950, there's been over 1,100 all-time highs, and one out of almost every 15 trading days actually hits a new all-time high. Now, I understand that past market returns does not guarantee anything moving forward, and I'm certainly not going to ignore the fact that the markets are indeed cyclical. A lot of times they're going up, followed by periods of retraction and sometimes even recession. But when you're thinking about your portfolio and how you can be building wealth, how do you make decisions when you hear that the markets are at all-time highs? Well, the fact is that nobody can predict where the market's going to be in the short term. No CFP, no analysts on CNBC, no stock trading guru can predict with any type of certainty where the market's going to go. So what does that mean for you building wealth? Well, I'm going to show you a quick example highlighting the importance of time in the market versus trying to time the market. But first, I need to give credit to one of my favorite authors and bloggers, Ben Carlson, who crunched all of these numbers in his book, A Wealth of Common Sense. Okay, so meet Mark, the miserable market timer. He began his career at the beginning of 1970 at age 22 and plans to retire at the end of 2013 at age 65. What Mark has going for him is that he's a very consistent saver. He plans to save $2,000 per year and then increase his savings by an additional $2,000 each decade until he retires at the end of 2013. So to summarize his savings, in 1970s, he's saving, like we said, $2,000 per year, and over the course of that decade, saved a total of $20,000. And then in the 1980s, he increased that savings from $2,000 to $4,000 per year for the entire decade for a total of $40,000 per year. And then in the 90s, once again, he bumped that up by $2,000 and is now saving $6,000 per year for a total of $60,000 throughout that decade. And then in the 2000s, bumped it up an additional $2,000, where he's saving now $8,000 per year for a total of $80,000 throughout that decade. And then as an additional 4 years until retiring at the end of 2013, where he saved a total of $40,000. And for a grand total of his entire working career, has saved $240,000. Mark does a great job saving, but he only saves his money to cash, except for the 4 times that he decides to jump into the market at the worst possible time, making him a miserable market timer. So let's dive into the first time he starts saving. In 1970, he's saving into cash for the first year. Second year, saving into cash. Third year, saving into cash. So now he has a total of $6,000, and he makes his first lump sum investment in December of 1972. And of course, what happens? The market goes down. Mark, from peak to trough, experiences a 48% decline. But the key is that Mark did not sell his investment. He just let it sit there, reinvesting his dividends. And then he continues to save into cash for the next 15 years, where he accumulates a total of $48,000. He then makes a lump sum deposit in August of 1987, right before the flash crash, where he experiences a 34% decline. But again, the key, Mark did not sell his investment. He just let it sit there, reinvesting his dividends. And then he continues to save back into cash, being terrified of the market. It takes him another 12 years of saving into cash before he decides to make another lump sum deposit in December of 1999, right at the peak of the dot-com bubble, where then Mark experiences a 55% market decline from peak to trough. Once again, he let the money sit there just collecting dividends, and then it would take him another 8 years of saving into cash before Mark made his final lump sum deposit of $68,000 into the market in October 2007, right before the Great Recession, where he experiences a massive 57% market decline. Once again, he let the money stay reinvesting his dividends, and the rest of his working days would just be saving simply into cash until he retires at the end of 2013. So in summary, Mark, the miserable market timer, saved a total of $240,000 and only made 4 contributions, lump sum contributions into the market during the 4 worst market recessions that we've seen in the last 50 years. And Mark still ended up with $1.1 million. Now, if Mark would have just simply dollar cost averaged his savings every single year, he would have ended up with $2.3 million. So even though Mark was a miserable market timer, he was still able to accumulate a lot of wealth by keeping his money in the market, reinvesting his dividends, and letting it just ride out and continue to grow. The bottom line is that over the last 100 years, the market has experienced rising and falling inflation, unemployment, interest rates, world wars, tons of international conflicts, president assassinations, and through all of this has still had annualized returns of over 9.5%. So if people are ranting and raving about markets being at all-time highs, I encourage you to shut out the noise, invest in low-cost, globally diversified portfolios, embrace the inevitable market volatility, systematically save, and stick to your strategy. Happy building wealth.